Right now, shares of Navitas Semiconductor, ticker NVTS, are trading at $8.59, posting a small intraday loss of about 0.58% or 5 cents. But that simple, slightly red number is incredibly misleading. The real story of today's session is the massive gap up at the open to $9.27, which has systematically faded all morning. This isn't just random volatility, it's the market trying to figure out what this company is worth after a brutal earnings report was followed just days later by a massive, and some would say confusing, $100 million capital raise. What we are watching is a live battle between the company's long-term promise and its very difficult short-term reality. The common belief, the one that has drawn so many investors to Navitas, is that this is a pure play on the future of power. Navitas designs and sells gallium nitride, or GaN, and silicon carbide, or SiC, power chips. These are, by all accounts, the successors to traditional silicon. They're smaller, they run cooler, and they are dramatically more efficient. The expectation is that as the world demands more power for artificial intelligence data centers, electric vehicles, solar inverters, and even our phone chargers, Navitas is positioned perfectly to supply the critical components that make it all work. This is the Navitas 2.0 story management is telling, a pivot to the high-growth, high-margin markets of the future, cemented by a key partnership to help power NVIDIA's next-generation 800-volt AI factory platforms. But that is the expectation. The reality, as shown by the stock's recent performance, is that this pivot is both painful and expensive. On November 3rd, the company reported its third-quarter earnings, and they were not good. Navitas posted a loss of 9 cents per share when a 5-cent loss was expected, and revenue came in at $10.1 million, missing the consensus estimate of nearly $11 million. Management then guided for fourth-quarter revenue to be just $7 million, which they are calling the revenue bottom. The stock, understandably, fell apart, plunging over 22% in the following days. Then, just as investors were processing this, the company announced it was raising $100 million in a private placement, selling shares at just $6.75 each. This move, while securing a necessary cash runway, was deeply dilutive and signaled to the market that the company needed cash, and it needed it fast. This brings us back to today's trading action. The stock is trading at $8.59, which is comfortably above that $6.75 placement price, but the fade from the $9.27 open shows that sellers are still in control. The volume so far today is moderate, but it represents a market that is deeply conflicted. The bulls see the $6.75 price as a floor set by institutions, while the bears see the weak earnings and dilutive capital raise as proof that the company's Navitas 2.0 story is still just a story and not a profitable business. This stock has been on a wild ride this year, climbing from lows near $1.52 to a high of $17.79, and that kind of volatility attracts a very specific kind of attention. We have to talk about the short seller interest in Navitas. This is not a fringe-level concern. It is a central part of the stock's profile. As of the last reported data at the end of October, the short interest as a percentage of the float was hovering at a very high 23 to 26%, depending on the source. That means for every 4 shares available to trade, 1 is being used to bet that the price will go down. The bear thesis is clear. The company is not profitable, it is burning cash, its valuation is stretched thin compared to its actual revenue, and this pivot away from its legacy low-margin China mobile business is proving to be a massive drag on growth. The Q3 earnings miss and weak Q4 guidance only added fuel to that fire. Now, this is where many retail investors get excited about a short squeeze, but it is crucial to look at the complete picture, and this is the actionable part. You can find short interest data on most major financial platforms, but do not just look at the percentage of float. You must also look at the days to cover, or the short ratio. For Navitas, that number is incredibly low, at around 1.08. This means based on average trading volume, all 40+ million shares that are sold short could theoretically be bought back and covered in about one single trading day. This makes a sustained, chaotic short squeeze much less probable. A high short interest with a high days to cover is explosive. A high short interest with a low days to cover, like we see here, suggests that the shorts are liquid and can get out of their positions relatively easily. Furthermore, the cost to borrow shares, or the borrow fee rate, is currently very low, under 1%. This tells us that even though many are short, it is not expensive to maintain those positions. So what's your read on this? Is the heavy short interest a sign of smart money caution, or is it an opportunity? Let us know in the comments. So what does Navitas Semiconductor actually do? In short, they are a fabless semiconductor company, meaning they design the chips but outsource the manufacturing primarily to partners like TSMC. Their focus is power conversion. Their GaN fast and GeneSiC technologies allow power systems to operate at much higher frequencies than old-fashioned silicon. This is what allows a 100-watt laptop charger to shrink to the size of an old phone charger. They are now applying the same principle, smaller, faster, more efficient, to the massive power racks inside AI data centers and the onboard chargers and drivetrains in electric vehicles. This is where the competition is. Navitas is not in a vacuum. It is competing directly with established giants like Texas Instruments, Infineon, and Wolfspeed, all of which have their own GaN and SiC solutions, deeper pockets, and massive manufacturing scale. Looking back, the stock's history has been one of high-growth hopes. It came public through a SPAC, and like so many others, it saw a massive initial spike, followed by a devastating crash as the market appetite shifted from growth at all costs to show me the profits. Navitas is still not profitable. While its losses have narrowed from past years, the path to profitability is the #1 question for investors. The recent $100 million in cash helps, giving them a buffer to execute their pivot. But it doesn't solve the fundamental problem. They need to start winning major, high-volume design contracts in the AI and EV space, and they need to do it soon. The sentiment we see on social platforms like Reddit and X is, as you would expect, completely divided. You have a core group of long-term holders who bought in last year and are still holding, believing in the technology's long-term superiority. Then you have a much more frustrated group looking at the recent earnings, the dilution, and the persistent short pressure, and wondering when the fundamentals will ever be allowed to matter. On the institutional side, ownership sits around 40%. Major firms like Vanguard and BlackRock have positions, which provide some stability, but it's not the 80 or 90% institutional backing you see in more mature, established companies. Looking ahead, the future of Navitas rests entirely on the execution of its Navitas 2.0 strategy. Management has clearly stated that the fourth quarter of 2025 will be the revenue bottom. This is a critical line in the sand. It means that starting in 2026, the market will demand to see sequential, quarter-over-quarter revenue growth. The catalysts investors are waiting for are not earnings beats. They are press releases announcing major design wins. A win with a major automotive OEM or a hyperscale data center provider would be a massive signal that the pivot is working. The risks are just as clear. If these wins do not materialize and competitors like Infineon lock up these long-term contracts, Navitas will be in a very difficult position. Another risk is the macroeconomic environment. If spending on new data centers or electric vehicle adoption slows, it directly impacts Navitas's target markets. This is a defining moment for the company. As we move into 2026, what single catalyst do you believe is most important for Navitas to prove its case? Is it a major EV win, or is it a data center contract? Comment below with what you are watching for. So when we look at Navitas today, we see the powerful expectation of a technology leader poised to own a piece of the future. But we are forced to reconcile that with the reality of a company in a costly and difficult transition, facing intense competition and significant pressure from short sellers, all while navigating a tough capital market. The simple story is that GaN and SiC are the future. The complex, financial reality is that Navitas stock is a high-risk, high-potential bet on whether this specific company can be the one to successfully commercialize it at scale.